All right, Gremlins, welcome back. Thank you all for joining me. Again, very happy with this turnout that we have. I was expecting a lot worse. We'll pick up where we left off last time. And I'll share my screen so you guys can see, our slide and everything. There we go. Okay. So we'll start with a quick talk about Bitcoin because it's actually included in the chapter. So we'll talk about like what cryptocurrencies are. Funny enough, the guy talked about from the whole Bitcoin sign incident actually texted me the other day. So pretty appropriate timing. So normally when we think about money, we talk about money, we think of currency that's issued by the government. That's basically what we've seen for the past 100 years or so in the Western world, if not longer. But currency is only a small part of the money supply. And over the last decade or so, we've seen a lot of advancements using the internet and using like peer-to-peer distributed ledgers where people are able to keep track of income, keep track of money and payments between individuals. Some of these are things like PayPal, you can pay through like Apple or whatever, where they're taking US dollars and they're just like paying it for you. Some of these are actually their own types of currencies. So like Bitcoin, Ethereum, Dogecoin, which is basically just like a meme for a while. So Bitcoins are a new form of e-money. They came about in like 2007 or 2009, but really didn't take off for a while. So Bitcoin isn't owned by any sort of government or even any firm. It's decentralized, so linked by a bunch of computers, basically a bunch of nerds who use their computers to make sure that all the transactions that occur are legit. You can go to different websites and you can trade Bitcoin for other currencies. So you can take US dollars and actually buy Bitcoins, or you can trade Bitcoins for other types of cryptocurrencies, things like Ethereum or other stuff like that. And there's some websites out there that accept Bitcoin as a form of payment. In DC, there's some food trucks down there that accept Bitcoins as a form of payment. So they ask the question, should Bitcoins be included in a measure of the money supply? Right now, probably not. They aren't included as part of the money supply. Even if they are popular, and a decent number of people have some sort of holding as Bitcoin, they're not being used as actual currency. We don't see them being used in transactions like we do typical US dollars, like old school greenbacks. Right now, Bitcoins are more like precious metal. So people buy them and hold them as like a store of value, hoping they're going to get some sort of return in the future as the value appreciates. The problem is that the value is volatile. So people don't want to accept Bitcoin as payment right now. Like I said, it's decentralized. The creation and overseeing the money supply of Bitcoin is decentralized among a lot of different users and people that validate the transactions. So you don't have like the Federal Reserve, controlling the money supply of Bitcoins like they do for US dollars. So the one thing, how Bitcoin safeguards the money supply to prevent, someone from just creating a bunch of Bitcoins into existence and spending them and then driving up inflation later. So basically they get all this benefit from creating this fake money and it just harms everyone else later with a higher price level. Is that they have a set path over time of how much Bitcoin is going to be in circulation. So the money supply has been increasing over time. At first it was like very steep and now it's like leveled off because it's late. In the existence of Bitcoin. And within like 2 to 3 years, they're going to stop creating new Bitcoins and the money supply is going to be static at that point. This is a really good way to prevent hyperinflation. There's a lot of monetary economists that have explored privately issued currencies like Bitcoin. The equilibrium is for people to just hyperinflate the currency. Anyone who has like any control over it. They get this benefit of spending a ton of money in the short term, and then no one else can use the currency. It becomes worthless in the long term. So Bitcoin solves that by limiting the money supply, by controlling its growth. Unfortunately, this is what makes the solution is what makes its value so volatile. So because of that, if more people want to hold Bitcoin and they spend US dollars to buy Bitcoin, the value is going to increase. If fewer people want to hold it, the value is going to decrease. So it's like constantly moving as more people buy and sell Bitcoin. That's why we see these really sharp daily fluctuations in the value of Bitcoin. So for day-to-day transactions, it's really not useful yet, especially when goods are priced in US dollars. And when a firm purchases the inputs for whatever product they're producing, they're purchasing those in US dollars. So if Bitcoin fluctuates a lot, they could gain a lot of money on each transaction, or they could lose a lot of money depending on if the value increases or decreases. So basically, for the value to be stable, you would need firms to price in Bitcoin, make that the menu price so that it stays stable. And then when they purchase like the inputs, those would also have to be sold to them in Bitcoin. And you would need the US government to accept Bitcoin to pay taxes. If not, you would still have that risk of when you went to pay taxes at the end of the day. The amount of money you would spend on tax could increase or decrease, again, based on the value of Bitcoin, how it changes that day. So because of that, people are very reluctant to accept Bitcoin as a form of payment. Maybe the payment of the future, but for the near term and even the midterm over the next couple decades, as someone who has a generally positive view of cryptocurrencies like Bitcoin, I don't see it being used as a currency at all. Still being used as like a precious metal, just as like an investment. Here's the price of Bitcoin as of last year. Prices increased some, or back up to about like $10,000, fairly consistently. But we see this massive spike here in 2018, or the end of 2017. It was really cool. I was like learning monetary theory, like taking that class in grad school, like learning all about like what cryptocurrencies are. Well, Bitcoin's like, shooting up to the moon. But eventually that came down, it settled again now around $10,000 for one Bitcoin. So you can just see the volatility over time. And you really don't want to, accept and like use a currency that's going to be that volatile. Okay, now that we're done with Bitcoin, let's move on to the money creation process. We'll be talking about how banks, through their operations, are involved in the money creation process, how they increase or decrease the money supply. Remember, banks are so important in the money supply process because more money is held in checking accounts than there is actually like greenbacks, like the currency that's circulating in the economy. And much of the actual currency is held outside of the US. So somehow banks are creating money. They're bringing it into existence and spending it. So we're going to look at this process a little bit. It's important to remember that banks are profit making, or they're seeking to make a profit, and they're private firms. Some of these are really small, where you have banks with like 1 or 2 branches in like small towns. Some banks are some of the largest corporations in the world. There's a lot of difference between the different types of banks and different bank companies. The activities, the way they're designed, the services that they offer, allow them to make a profit. So in order to understand what roles banks play in the economy and in the money supply, the money creation process, we're going to try to understand how banks operate as a business. And through seeing how banks operate as a business, we'll see what their effect on the money supply is. So here we have the balance sheet of a very typical large bank. On the left-hand side, we have the assets. On the right-hand side, we have liabilities and stockholders' equity. The sum of assets and the sum of liabilities and stockholder equities, by definition, have to equal each other. So if you look at the very bottom, you have total assets, $2,300 billion. Total liabilities and stockholder equities, again, $2,300 billion. This isn't just like an accident. This isn't a simplified example. This is, by definition, they're going to equal each other. This is a lot of accounting, and I know most of you haven't taken accounting classes and won't have to take accounting classes. So we'll be relying this to illustrate what's going on, and we'll be working through this chapter with much simpler asset and liability like balance sheet. But this is basically, so you know what we're talking about, this is what it looks like. So on the left, we have the bank's assets. They have their reserves, so the amount of cash they keep on hand at any time, so that they're able to pay depositors that are trying to withdraw funds from their account. Then another set of assets are the loans. So loans they give to consumers to buy a house or to buy a car, and loans to firms to expand their operations, to buy new capital. They also have their securities portfolio. So these are assets that they buy, like stocks and bonds, these sorts of things that they buy hoping that they're going to appreciate in value so that they can earn some sort of profit on it. Then you have other things like buildings and equipment and other assets. The reason why banks take some of the money that's deposited, and instead of keeping it in their vaults, they loan it out or they purchase securities, is that it costs money to run a bank. So their options are either charge someone to keep their money in the bank, to have that account, which is basically the idea of safety deposit boxes, that you pay the bank every month to have this box there that they protect and have the services, the employees that make it easier to work with it and to deal with it. The other option is to not charge people to leave their money in the bank, but to take some of it and earn a profit from there, so they can pay for the building, pay for the employees, pay for all the services that they're offering people. So that's what banks typically do, and that's why we see what's called a fractional reserve banking system. I think I mentioned this last class, but a fractional reserve banking system just means that they're going to hold some of the assets in reserves. So some of the money deposited will remain at the bank, so you can get the money if you need it. But a lot of the money is going to be loaned out. They're going to be using it somehow to earn a profit. That's the goal, like any other private business. On the right side here, we have liabilities and stockholder equities, or equity. The biggest liability that banks have is the deposits. So like the assets they're going to make money from, that's something of value to them. Liabilities is something they owe to someone else. So deposits aren't owned by them, it's owned by the individual depositors. So anytime, like on demand, they're going to have to pay that back to the depositors. So it's not theirs to work with. There's also short-term borrowing. So banks will borrow in the short term so they can meet their reserve requirements. And we'll talk about that more later. But the important thing to know is that they have some sort of lending for the very short term. They also have longer term debt. And these are the liabilities that they have to pay on every month for years and years. There's other liabilities, and then there's stockholders' equity, the profit, the value above, or the value of their assets above the liabilities. It's like the profit the firm's making that they can either reinvest into the firm or they can pay to shareholders. So basically what banks do to make money, they use the money that's deposited at the bank with them to make loans and to buy securities. That's how they earn a profit. So here we have the balance sheet of a typical large bank. Same thing. Reserves are the deposits that a bank keeps in cash in its vault. So if you go to the bank and you talk to the teller, they have like a little drawer of cash there. They run low on that, they can go back to the vault where they have a bunch of cash sitting. They also keep reserves at the Federal Reserve. So they have money sitting at the Federal Reserve that they can then use to pay people that are withdrawing from their accounts. And again, this is a fractional reserve banking system. So I want you to note that the reserves on hand in this example, $135 billion is kept at the bank or at the Federal Reserve in cash so that they can pay depositors. But their deposits total are $1 trillion, $1,000 billion. So they don't keep enough cash on hand in order to pay back all their depositors. If you try to make a big withdrawal from your bank, like thousands and thousands of dollars, they will tell you that you can't pull it out all at once, that you need to give them a couple days notice. For some reason, my dad had to pull out like $2,000 from his account. I think it was, might have been to buy a used car. And he was very upset that they said, well, no, you can't pull it out until Friday. And it was like Tuesday. He's like, it's my money. And they're like, yes, but because we don't keep enough cash on hand. It's that basic idea that they don't have enough cash on hand because they're making these investments and making these loans. So there's two types of reserves. There's required and excess reserves. The bank has to keep, by law, some cash available for the depositors. So it does this through vault cash, like I said, and through deposits at the Federal Reserve. In the US, for the past 100 or so years, probably longer than that, banks are required to hold a certain level of reserves. By law, they have to keep a certain percentage of their assets or a certain percentage of deposits on hand. And this is based entirely on their checking account deposits. Currently, the required reserve is 10% of their checking accounts above some threshold. 2015, it was 103.6 million. It's increased a little bit since then, but I'm not sure the exact number. So we call 10% the required reserve ratio. So that's the minimum fraction of deposits that banks are required by law to keep as reserves. So every bank is going to keep at least 10% of their deposits on hand as cash or at the Federal Reserve as cash. Again, required because of law. Although banks sometimes hold more than those reserve requirements. We call these excess reserves. So sometimes banks decide to keep extra money on hand, even though it could be loaned out to or invested to make the money. Maybe there's problems in the market. The market's not doing very well. So they think it's less risky to keep the cash on hand. Alternatively, since 2008, the Federal Reserve has been paying an interest rate on excess reserves. This was done during the recession to encourage banks to remain sound, so they had enough of a cushion if a bunch of depositors came in, there was a run on a bank and they wanted to withdraw a bunch of money from their accounts. But this comes at a cost. These banks are safer. They have a greater cushion, which is a good thing to encourage safety, but it comes at a cost. There ends up being less lending to firms and individuals, so it lowers GDP growth. So we end up with a lower standard of living relative to what we would have had if banks weren't holding such high level of excess reserves. Obviously, there's you have to have the trade-off of high growth and the safety and the soundness of the system. So let's go and let's actually look at the money creation process for an example bank. So we're going to look at Bank of America, particularly large bank. We'll look at their assets and the liabilities in what we call a T account. So T account will have the assets on the left side and the liabilities on the right side. In this example, we're not even worrying about shareholders' equity, and we're not worrying about many of the different types of assets and liabilities. But still, by definition, the assets and the liabilities are going to equal each other. So let's say an individual deposits $1,000 in their account at Bank of America. That's going to increase the assets and liabilities for Bank of America by $1,000. Their reserves increase by $1,000 because you've taken a bunch of cash and you set it down, on the counter. They take and they put it in the bowl. Their deposits have also increased by $1,000 because that money is being credited to your account. So the currency component of the money supply is going to decrease by $1,000. Again, you just took $1,000 that were in circulation and you put it in the bank. So you pulled it out of the money supply, out of circulation. But the checking account deposits just increased by $1,000 because that money didn't disappear, it just went into your account. So there's no net change in the money supply at this point. But this initial change is not the end of the story. Bank of America is trying to earn a profit. So what is B of A going to do? They're not just going to let it sit in their vaults because the money doesn't do anything. It's actually going to cost them money because if they let it sit there, they still have to pay for security, they still have to pay on the building, they still have to pay their employees, all these different things. So what they're going to do is try to make their money work for them. Either they're going to lend it out or they're going to invest it in some sort of asset. For this example, we'll look at them lending the money out. So let's assume that they hold no excess reserves, that they only have to hold 10% on hand, so they're only going to keep 10% on hand. The other 90% is going to be lent out to actually make the money. And so what they're going to do is only keep 10% on hand, they're going to lend out 90%. So they're going to increase their loans by $900 or 90% of $1,000. For this example, let's say someone's, they want to buy a cheap used car. So they're going to take that $900 loan and they're going to buy a used car. So what they're going to do is credit that $900 to that person's checking account. So we have their assets increased by $900. That loan is, going to be repaid by that individual. So that's a $900, asset that they have. It's also a liability because that money has been deposited in that person's account, which they're then going to use to buy the car. So temporarily, what we see is the reserves have increased, or the assets have increased by $900, and the deposits have increased by $900 because they now have that additional money in the bank. But it's not going to last very long because after the money goes in the person's checking account, pretty soon they're going to use it to buy the car and it's going to leave their account. So here is the next step. We'll follow the money through this process. Now we're going to assume that the money, that person that purchases the car, the person they're buying the car from has an account at PNC Bank. The reason we use PNC and not just a different branch of Bank of America is to make the example more clear. So we're not dealing with two Bank of Americas. But it can go to any bank. It can stay at Bank of America. It can go to a small bank, a large bank, what have you. So Now Bank of America's reserves are going to fall to $100 from $1,000. What's going to happen is that that $900 check that was deposited at the PNC location, it's going to get cleared. So Bank of America sends that $900 to PNC Bank. So the reserves fall. So then their liabilities, that $900 in that account, is also going to disappear because now that $900 is going to PNC. It's pulled out of that individual's account and paid to whoever they're purchasing the car from. So it's no longer of a concern to Bank of America. When Bank of America pays the $900 out of their reserves to PNC Bank, it's called clearing a check. So the bank actively settles the payment. So now their assets are $100 in reserves at B of A, and the loans are $900. So they still have this $1,000 worth of assets that we saw at the beginning of this example. And their deposits are still $1,000. That initial deposit that you put in the bank at B of A is still there. PNC now has an additional $900 in reserves. So that $900 that was used to buy that car is now deposited at PNC Bank. So their assets increased by $900. They have that cash on hand, so it's something of value. And the liabilities increased by $900 because they now owe that depositor $900 if they want to come and take the money out. But now PNC also wants to earn a profit. They're not just going to sit back and spend the money to operate as a bank without earning some sort of profit, making some sort of money from it so they can continue to exist. So what they're going to do is lend out 90% of their new reserves to some other firm or some individual, and the cycle is going to continue. So when will it end? And no, I'm not talking about this class, although I'm sure you're thinking it. I'm talking about the money creation process. So each round we go through, PNC loans it out to someone just like before, but they are loaning out 90%, not 100%. So it drops from $900, they make an $810 loan. That gets deposited into another bank, and we see this process happen again. 90% of that $810 is then lent out again, so it's going to be $729. And it's going to go on and on and on until that amount gets smaller and smaller. Each time, 10% of deposits are kept as reserves, but 90% is going to be lent out. So we can use this to figure out how much checking deposits are going to eventually increase. This $1,000 that you deposit in the first round at Bank of America now becomes $10,000 in checking deposits. So 1,000, when there's a 10% required reserve, results in $10,000 of currency being created. So we've now expanded the money supply by $9,000 just from that one initial deposit. So banks trying to earn a profit, acting in their own self-interest, increases this money supply, helps grow it. So we see people able to borrow to purchase houses, to go to college, to purchase a car, what have you. We have firms able to expand their operations and buy new capital, new equipment to make them more productive. All this possible because we have these banks loaning out this money, trying to earn a profit. This next slide walks you through the math, an alternative way to figure out, instead of going through each round and looking at each bank, this math you can do to just add it all up. We'll skip to the next slide because I'm not going to waste your time doing algebra here. Basically, you take that initial $1,000, multiply 1 divided by the reserve required ratio. The required reserve ratio is 10% or 0.10. So 1 divided by 0.10 is 10. So $1,000, the initial deposit, times 10 equals $10,000. So that gives us the same answer. So the 10 here is called the simple deposit multiplier. So it's the ratio of the amount of deposits created by the bank to the amount of new reserves. So we can write that number as 1 divided by the reserve requirement. If it was 8%, the reserve requirement, then our simple deposit multiplier would be 1 divided by 0.08. If it was 12, the reserve required ratio was 12%, then it'd be 1 divided by 0.12. So with the 10% reserve required reserve ratio, which is what we have in the United States today, the simple deposit multiplier is 10. So each dollar that is deposited in a bank is going to result in $10 in the money supply. So that gives you an idea of how much money is created just by banks operating normally. Now, obviously, I've talked several times in this class about models, how we simplify the world, and that's true in this case. The simple deposit multiplier is fairly different from the real world deposit multiplier. Even though this 10% required reserve ratio should result in currency deposit will be multiplied 10 times, so we see the money supply increase by 10 times over that initial deposit. We don't see this in reality. In the real world, currency deposits end up being multiplied, economists estimate about 2.5 times over the long term during normal periods, not during like recessions or I guess super big expansions. So the reason that this occurs is that banks don't want to lend out as much as we predict. Normally they keep some amount of excess reserves on hand, or they can't find creditworthy borrowers. So even after the Great Recession, where banks initially pulled back their lending because it was a recession, like people were losing their jobs, so there was a lot of risk in extending these loans. Even as the economy recovered, they were very hesitant to make these home mortgage loans to people that didn't have super high like credit scores, people that they considered to be a risk of not being able to pay back. So they would just keep that money on hand as excess reserves. And now, since like 2008, the Federal Reserve pays banks an interest rate to keep some excess reserves. So we end up with banks, obviously if you incentivize people to do something, you guarantee them like they're going to get the money back with a small like rate of interest. You're guaranteed a small profit on complete safety. So these banks are going to be willing to keep excess reserves. And there's also a problem that consumers keep some currency out of the bank. It's not a problem for economies or how people live. It is a problem if you want the simple deposit multiplier to be closer to the real world deposit multiplier. When people keep currency out of the bank, that dampens the money creation process. Because people are holding on to currency, there's less money being deposited in banks, so it's less money that banks can lend out. And during the recession, 2007, 2009, some economists have estimated that the real world multiplier fell close to 1. So basically, when people were putting money in banks, only that much money was being created. We weren't seeing this process that we see in normal times. And even at one point during the financial crisis early on, lending between banks completely stopped. This is like a super rare event. So there's very little confidence in the economy, very little lending going on in general. Another reason why the multiplier fell to close to 1 or close to 1. So what can we conclude about banks and the money supply? What has this example been an illustration of? I'm not going to have you walk through and like literally go through these or like show like T accounts as we like on exams to figure out what's going on. The point, what I want you to understand is that when banks gain reserves, when people deposit money in their account and they have this cash on hand, they're not just going to sit on it. They're going to make new loans to individuals and make new loans to firms. So the money supply is going to expand. And when banks lose reserves, they're going to reduce their loans and the money supply is going to contract. This is incredibly important for monetary policy because this relationship is what the Federal Reserve takes advantage of in order to influence the interest rates and the money supply. I think there was something else I wanted to tell you about this slide, but that's generally why we went through this, why we walked through this example, so you can see how the Federal Reserve operates, which we'll talk about a little bit today, and we'll really get into in depth on Friday. So now we've established this relationship between banks and the money supply. Now we'll move on to the Federal Reserve System, and I'll give you a very brief introduction to the Federal Reserve System today, and hopefully we can get out considerably early, not just a couple minutes early. All right, so we've described in the United States how banks keep less than 100% of their deposits on hand as reserves. So if everyone showed up at once to withdraw, from their accounts, banks would not be able to cover that. This is called a fractional reserve banking system, and it's shared by pretty much every country. There's a few radical economists, I guess you would say. Maybe most of them aren't economists. that don't like the fractional reserve banking system. They believe it's just outright fraud. That's not true. This is very simple. Fractional reserve banking has existed for centuries. Even like early banks in Britain in like the 14 or 1300s had been operating as fractional reserve banks, where they had some on hand, but they loaned out a bunch of money. So this has been going on for a long time. It was upheld by courts in Britain in like the 1500s. So it has been legit, at least somewhere in the world, for a long time. This is all well and good. Fractional reserve banking helps out the economy. It allows banks to make loans. It facilitates these financial transactions, borrowing for individuals and for firms. So it allows us to make investments in both durable goods to make our lives better. Instead of saving up money over time and then purchasing something, you can purchase it now and then pay it back later. It also allows firms to expand much more than they would be able to without being able to get these loans. But there are problems with a fractional reserve banking system. There is some risk involved that banks are going to have to shut down, that they won't have enough money on hand to pay back all their depositors if too many depositors try to withdraw their money at once. We call this a bank run, when a lot of people show up at once trying to pull money out of their deposits. And if a lot of banks experience a bank run, we call it a banking panic. But this banking panic is widespread across a lot of different banks. Many people believe that a fractional reserve banking system requires a lender of last resort, that you need someone like the Federal Reserve to step in and be willing to lend to these banks when no one else is willing to, just to make sure they have enough cash on hand to meet these obligations of their depositors. Banks are typically slightly over or slightly under their reserve to acquire ratio at the end of the day. They're normally not at exactly 10%. They'll have a little bit of extra cash on hand because fewer depositors than they expected came to withdraw some of their funds, or maybe some more than they expected came to withdraw their funds. They have a little bit less than the 10%. So what they do is banks lend and borrow from each other just for that night so they can meet these requirements. So the bank has, say, 9% of their deposits on hand as reserves with 5 minutes left in the day. What they do is they go to another bank and they ask them that has, another bank with some reserves on hand, extra, like above the required, and say, hey, can I borrow this just for the night? And they say, sure. Give me 1% interest and pay me back first thing in the morning. So that bank borrows it, they meet the Fed's requirements, and the next morning they give it back plus that little bit of interest. During panics, many depositors rush to withdraw from their account. So when there's a bank run, it's just at one bank. When there's a panic, this is going on at a lot of banks at this time. Banks need to do they can do one of two things. They can sell their assets. Normally, if they try to sell their assets during a bank run or during a banking panic, it'll be what they call a fire sale. So prices of those assets are going to fall. Odds are they fell to help precipitate this banking panic. But also, as banks try to sell a large amount of their assets, that's going to drive the price down. Necessarily, that's how the market works. So banks are going to get less and less money for these assets than they would if they didn't have to sell them. The other option that banks can do is they can borrow in the short term. So they could borrow, even more money from other banks to make sure that they're able to pay their depositors that are withdrawing money. If just one bank is experiencing a bank run, this isn't too big of a problem. As long as the bank is healthy and it's just something outside of their control going on, they can get lending from most other banks. That's not really going to be an issue. But if there's a banking panic, or if there's something wrong with the bank's underlying assets that people suddenly notice that they're now not as highly valued as they were before, banks will be very reluctant to lend to them. So at a certain point, they're not going to step in and lend to a bank that's struggling during a banking run. So starting with Walter Bagehot, some British dude he was like the first editor of the magazine The Economist, which is still around today. He was very involved with the Bank of England. He said that somebody, a central bank, needs to step in and lend at a penalty interest rate. So typically, banks lend to each other overnight at a very low rate. Some central bank needs to be the lender of last resort. If other banks will lend to them, this central bank needs to step in and do so. Do so at a slightly higher interest rate, to penalize a bank for having to go to them for reaching that point, but still support this bank to make sure that depositors can get all their money out. And the important thing is that they're keeping solvent but illiquid banks operating. What I mean by solvent but illiquid is that the banks struggle to sell their assets. They would, if they sold their assets, it would be a fire sale. It would be much lower than their value actually is in normal times because of, them going and trying to sell these all at the last second. It'd be very difficult for them to sell them all at a decent value. But the bank does have enough money overall. Their assets are valuable enough that if this, bank run wasn't going on, they'd be fine to operate. So these are still healthy banks. They're just struggling in the moment. He believed, and most people believe, that we need a lender of last resort to step in and do this. So this is one of the reasons why the Federal Reserve was brought into existence, so they could serve as the lender of last resort during these banking panics. So this figure right here shows how banking panics take place. And this is something you're going to want to remember for the final, because this is, how business cycles reach their peak and then start to collapse. So first, there's some sort of bad news. Charles Kindleberger, who talks about the anatomy of financial crises, calls this a displacement. Basically, some news comes out, something changes, that depositors begin to question the value of the bank's underlying assets. They don't think the bank has enough money on hand, and they're not able to sell their assets in order to pay back all their depositors. So what happens is a bank run. People run up and they try to withdraw as much money from their account as possible. They don't want to be the last person stuck because they know there's not enough money that's going to be on hand. You don't want to be last because, again, at a certain point, the bank runs out of money and then they just shut down and you're screwed. It's happened in the Great Depression. A lot of people lost money in banks, and that's why your grandparents or maybe great-grandparents would keep shoeboxes of cash under their mattress. Well, probably not shoeboxes under their mattress, but keep cash under their mattress or shoeboxes of cash in their closet because they didn't trust banks because of these bank runs. If you're not first in line, towards the front of the line, you're losing out on your money. If you've ever seen the movie It's a Wonderful Life, I know it's a super old movie, it's black and white, but a lot of people watch it around Christmas time. This shows a bank run, pretty much a perfect situation of it. There's that bad news that caused a ton of people to come in and try to withdraw all their money because they don't think the bank's going to make it. So Jimmy Stewart stands up there at the front desk of the savings and loan, and he convinces people only take a portion of your deposits so the bank can remain open. He asks people, like, how much do you need to get you through the next 2 days? And there's bickering, there's going back and forth with them. And he said, no, within the next 2 days, we're going to have the money. We just don't have enough on our hand right now. And he uses his role in the community and his smooth talking ability to get people to accept a small portion of their deposits, convincing them that they're going to be able to get their money out a couple days later. I think the scene, at the end of the day, he's him and two coworkers counting down. It's 3, 2, 1. There's $3 or $4 sitting in front. That's all they had left in their reserves that day. But they were able to stave off the bank run and not go insolvent. As people see these bank runs happen at one bank or two banks that happen to be unhealthy, they start to get nervous about their bank. If there's enough bad stuff going on in the economy, if they're starting to question the health of their bank because of the assets their banks hold, or because of the likelihood of their bank going down because of the number of other banks, they may try to withdraw funds from their account. This is called contagion. As bad things happening at one bank, distrust in one bank's ability to continue operating and paying their depositors affects other banks that weren't unhealthy initially. So now these healthy banks, when they're affected, they become illiquid. So they struggle to sell their assets at a reasonable price. So they don't want to conduct these fire sales to lose a bunch of money on their assets. So they have to try to either sell their assets at this lower value and take a loss. They curtail their lending to firms and to consumers so they can pay back those depositors. They have money coming in from the loan payments every month. They just use those to pay back depositors instead of making new loans. So again, this dampens the money creation process, dampens GDP and output. Or they try to borrow. And again, borrowing is going to be very difficult when there's a lot of banks being involved in this contagion. A lot of banks suffering from simultaneous bank runs. Like I said, this is going to hit the broader economy. We're going to see output fall We see employment fall, so unemployment increases, people lose their jobs as firms suffer from lower demand. And the economy enters a recession. So this is bad for people. A lot of people say, fuck the banks, big banks don't care about us. And I mean, they probably don't really care about you, but the health of banks is very important for people's everyday lives. If we see these problems, if we see banking panics and banking runs, if there's not some sort of support from a lender of last resort in these situations, sure, it hurts banks, and you can laugh about these rich fat cat bankers suffering, but it's also going to cause the broader economy to suffer. So people are going to suffer. They're going to lose their jobs. We're going to see output fall. Standard of living is going to fall because of these banking panics. So what the lender of last resort can do by being willing to provide these loans, it'll allow banks to have more confidence if one bank is experiencing a run to be willing to lend to them because they know that there is this lender of last resort in the background. And banks know that even if they're struggling, they have somewhere to go to get money to cover their short-term operations. All right, I'm going to end here for the day. We got about 10 minutes left in class normally, but I'm sure you don't want to sit at a computer screen any longer. So next class on Friday, I'll be back in person. I'm allowed to come out of quarantine next Friday, or on Friday. So we'll talk about the Federal Reserve, the establishment of the system, and how the Federal Reserve functions, its structure. And then we'll talk about the financial crisis, probably a little bit on Friday, and then we'll do that in class on Monday. If you guys have any questions, again, you can pop it in the chat if you'd like, or you can email me later. If not, I'll see you on Friday and we can talk about it then. I'll leave this open for a few minutes, but then you guys can leave whenever the hell you want.